Tools of accounting trade. Tools of accounting trade. All accountants rely on record keeping, either manual or electronic, to enter and track transactions. Underlying all record keeping procedures are the two key concepts of accounting: the accounting equation and double entry accounting. The accounting equation. At various points in the year, accountants use the following equation to balance the data pertaining to financial transactions. Well, assets are equal to liabilities plus owner's equity. To understand the importance of this equation, we must obviously understand the terms assets, liabilities, and owner's equity. Assets and liabilities. An asset is an economic resource that is expected to benefit a firm or individual who owns it. Asset includes land, building, equipment, inventory, and payment due the company accounts receivable, and liability is a debt that the firm owes to an outside party. Owner's equity. You may have heard of the equity that a homeowner has in a house. That is the amount of money that could be made by selling the house and paying off the mortgage. Similarly, owner's equity is the amount of money that owners would receive if they sold all the company's assets and paid all of their liabilities. We can write the accounting equation to highlight this definition. It in fact gives us a formula. If a company's assets exceeds the liability, owner's equity is positive. If the company goes out of business, the owners will receive some cash and gains after selling the assets and paying off the liabilities. If liabilities outweigh assets, owner's equity is negative, assets are insufficient to pay off all debts, the company goes out of business. The owners will get no cash and some creditors won't be paid. Owner's equity is meaningful for both investors and lenders. Before lending money to the owners, for example, lenders want to know amount of the owner's equity in a business. Owner's equity consists of two sources of capital. Number one, the amount that owners originally invested. Number two, the profits earned and reinvested in the company. When a company operates profitably, its assets increase faster than its liabilities. Owners' equity, therefore, will increase if profits are retained in the business instead of paid out as dividends to stockholders. Owners' equity also increases if owners invest more of their own money to increase the assets. However, owners' equity can shrink if the company operates at a loss or if owners withdraws the assets. Double at double entry accounting. If your business buys inventory with cash, you decrease your cash and increase your inventory. Similarly, if you buy supplies on credit, you increase your supplies and increase your accounts payable. If you invest more money in your business, you increase the company's cash and increase your owner's equity. I beg your pardon, please forgive me. I've got a sore throat, flu, fever, but I continue and I don't take a holiday even on a Sunday. In other words, every transaction affects two accountants. In other words, every transaction affects two accounts. Accountants thus use a double entry accounting system to record the dual effects of transaction. This practice ensures that the accounting equation always balances. We'll talk about financial statements when we move to the next video. That's all for this video.